Hello and welcome to CRT Basic to Advanced Mentorship. We'll be looking at types of market structure. The first structure that we have, it is a bullish structure where the market it is going higher and higher, and that is known as an uptrend. We've covered that in the market structure video and the advanced market structure. And then the second type of structure, we then dealt with it also. It is a bearish market structure where the market is moving lower and lower. This is known as a downtrend. And we then have a third structure, which is a reversal, right? Which we've also dealt with it, which is a trend change where the market was moving high, and then the place where we're looking at it as a strong low, it has been broken, and then now that it has been broken, the trend has changed. We are bearish from that point onwards. We then looked at the other type of structure, which was a ranging market known as a consolidation, where the market is ranging between two areas, a low and a high. The market is just between that area, and that is a consolidation. And we also spoke about how one could trade this type of structure where below the lows, you then buy, above the highs, you then sell, and then it continues just like that. And I then advised that within this type of structure, you rather work above and below the major highs and lows, right? And you would sell above those highs and you would buy below those lows. So today we are looking into the types of structures that we need to work within and how they would help us for high probability trades, right? So for high probability trades, they need to come from a specific area, which is a key level. So what we are looking at, we need to look at higher time frame objectives and then into a lower time frame key levels, and then we are looking at lower time frame executions, right? Therefore, what you have in terms of structure, you have a higher time frame structure, you have an internal structure, you then have an execution structure where you execute your trades, right? So our higher time frame structure will give us our narrative, and then our medium time frame structure will give us our immediate bias, what's going on right now, and the key levels that we need to be trading from. And then the last one would be our execution, where we get in there and we execute at the medium time frame key levels, right? And in that way, we'll then have what you call high probability trades. So they come from those areas. So we are always looking to trade or take our trades from a higher time frame overall direction. Therefore, we want to be buying from the lows going to their highs if ever we are on an uptrend. And then if we're on a downtrend, we want to buy from that area going to the lows, right? So that is what we are looking at. And when you are looking from the higher time frame and you worked your way down for timing, you then see good trades coming out of that. So what is very important that we need to take home is to trade from a strong structure to a weak structure. This is where our market maker models form. What is a market maker model? When you're looking at a market maker model, it tells you that we have a sell side and then you have the buy side curve. So it means we are selling to buy the market. Therefore, when you are looking at the market, you will then look to sell the market going to the downside into your key levels. From your key levels, you are looking for a buy curve going out of that area, going to the original consolidation, which is above the weak highs. And then at our strong lows, we then have a key level where our market maker model will then turn into a buy. So we are coming from a sell market maker model to a buy market maker model. In front of us, we are looking at an example of an intraday trader, someone who's coming in every day into the chart and they are looking to take trades, right? An intraday trader needs to have three time frames that they are looking the market from. So as you can see here, I've highlighted an intraday traders time frames that they need to operate from. What we are looking at, an intraday trader would either use a higher time frame, which is a daily chart, or a higher time frame as a 4-hour chart. It is absolutely up to a trader which time frames they want to use. Medium time frames, you would see that if you are taking the daily time frame, you need to use a medium time frame as an hourly chart, and then your lower time frame for executing your trades will be the 5-minute. And then if you are using a 4-hour chart as your higher time frame, and then your 15 minutes chart will be your medium time frame, your 1-minute chart will be your lower time frame for executing your trades. Therefore, when we are looking at the market from this standpoint, we then have a higher time frame that is bullish. Therefore, this is a strong low and that is a weak high. We have this area as a dealing range after we have taken out the structure above. After taking out a structure, we are expecting a pullback. Now, on the medium time frame structure, you will then see something like this. The market will start breaking structure on the lower time frame, which is your 15 minutes chart, and then we start breaking down. And what you will often see, what traps a lot of traders, it is that 15 minutes when it breaks that high, even with a candle closure, someone will then say now they are bullish, they would be looking to take buys from this area. But if you are looking at this market from the higher time frame perspective, this then become a liquidity sweep, so that we might be able to push down up until we hit a key level. Right, so the market comes into the key level, comes and do another liquidity sweep. This does happen in the market, and the market then comes, takes out liquidity inside the key level. Now we can wait for a market structure shift. Now when the market structure is shift bullish, we then mark our key levels on that 15 minutes chart. Now this will be our key level. We have liquidity. Maybe at below we also have a key level also, right? 2 key levels, liquidity, probably an order block below, and then we are looking for this market to drop into that area, and then we'll then look for buys. Right, now as we are waiting, if you go to a lower time frame, you'll see the very same thing. The market will break structure, then pull back, break structure, also pull back, and then if it takes out that high, that's just a sweep of liquidity. That's how you know how to identify some of these sweep of liquidity targeting your area of interest. Now you also have another market maker model, but on a lower time frame. You have a key level below. Now the market will have to sell in order to buy. Right, so as it is selling, you are having your market maker model on the lower time frame. We take out that low, tap into our key level, and then that then forms our market structure shift. We are looking for a key level to buy that market. Now we are targeting those weak highs. So that is actually the process, and this can be the daily, an hour, and this can be the 5 minutes, right, for intraday traders. This is how you would be looking at the market. Therefore, let's hop into the market and see these examples live. Now, let us look into our charts, and we are looking at the step index chart, and this is a 4-hour chart as our higher time frame. We see the market takes out a high right here, and we drop and take out a low. After taking out a low, we're expecting a pullback in the market, and we then mark our key level, and this is our strong high. We shouldn't see the market closing above this area. We want this key level to give us a reaction from there, so that we might trade from this area going to these lows. Now we'll then move into our 15 minutes chart and look within this area how we would have found out that the market is ready to go high. You will then go to your 15 minutes chart, and after you have went to your 15 minutes chart, you will then pull back. As you can see, 15 minutes chart, we have a pullback. We then break below the lows, and then in order for us to change direction, we want the market to go above those highs. Indeed, the market came and take out those highs, and then we then see a retracement before the market pushed to a strong high, because right now we have a strong low here. Why would we have a strong low here? When the market came out of this area, this order block was retested, this order block was retested, this fair value gap was retested, and this fair value gap was then retested, and there was liquidity. When this order block was formed, liquidity was taken out and the market pushed high. So we have some liquidity below this, above actually this order block. So that will be our 15 minutes point of interest. So as the market is going down, we get into that area, we start pushing high, we fail to take out the highs. As the market is coming back, we have these lows above the key level. So the market takes out those lows and then we start pushing high. What you will then notice it is that we have strong lows now. Here we have strong lows and we have strong highs after breaking above this high, this 15 minutes high. And then from that point onward, you then have all of these PD arrays are tested. And when you look, the market pushed high, came back and also tested this one. This is the one PD array that is fresh and clean. So you have that order block, will then mark that as a point of interest. And we've just noticed that the market didn't hit our 4-hour POI. Therefore, what I want us to look, it is the market from this week high to this strong low, and then we can then look into taking trades from this area to that high. So how would we have looked into this area, trading into this key level and then trading out of that key level? I want us also to look at when the market came out of the key level on the 15 minutes chart, which is our medium time frame. We took out that high aggressively. We then consolidated, push high, and then the market dropped lower, and we have this order block over here, change in the state of delivery. Above that change in the state of delivery, we have our liquidity, and when this was happening, I want us to notice that also, right? So we'll go down to a 1 minute chart, come back into these areas, and let's look at how the market, how would have played out, or how would have traded into this area and bought from this area to that high. So that will be our market maker model. You have your original consolidation, you have your key point of interest where the market will turn, and then you have a sell side and a buy side. So this is your TP. So we are selling into a key level, then we buy into our original consolidation. So that's your market maker model complete. Sell side, buy side. So let's look into this in a 1 minute chart, and let's see how we would have looked into trading that market. So let me just zoom out and find that spot. All right, this is the area. We'll then zoom in. Let's work around this. Here's what is happening. The market is bullish. We're making higher highs and higher lows. So the market takes out this low. We push high. We then have that as a strong low and then a weak high. It is then broken. We then retrace to that, and then to that breakup block, the market move high. This should be strong. The market then breaks below it. Now that's a strong high. This is a weak low. The market comes back into this area, fails to take it out. If you take a look, the market didn't take it out. And then when the market dropped, we had no entry. We then pulled back, but the market closed below this low. That's a market structure shift. We have a fair value gap and an order block as an area where we can take an entry. So the market taps into that. We are then targeting that low. And when the market reached this low, that's where your scalp was done. Take your entry, then you are out. Then the market retraces and then doesn't take out the strong high, right? We just sweep the strong high, but we don't have an entry yet. The market drops, pulls back again, drop aggressively. Now you have a fair value gap, an order block to take a trade from. Then we have that as a key point of interest with our liquidity above it. The market goes above that. That's where we take our entries, stop loss above, and we are targeting these lows. The market comes close above this low, then retrace, then we drop. We retrace into a fair value gap right here in this area, and then we drop. And then we have this is strong, that is weak. We then have the market retracing into a fair value gap above 50%, if you will, and taking out liquidity. Then the market drops, and then we have another market structure from this low to that high. because this low was violated here. The market then pulled back, took out liquidity in this area, and then it dropped. So with this is strong, this is weak. With our pullback into our point of interests, right? In our point of interests, and then the market drops to the low, targeting these lows. And then the market drops below that, then give us a pullback. We have not reached our key level. Then the market then drops into our key level, and then we are looking at that high to be taken out. And then you can see this market close above that high after we have tapped into our key level. Now we are looking at this area as a key level to buy. Now we have an order block here, fair value gap. The market comes into that, we can buy that. Stop loss comes below, and we are targeting those highs, and the market moves high, 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 right? I want us to look at something as the market is moving high. When we reach a certain level, the market then breaks structure. We take out those highs. This low took out that liquidity. Therefore, it is a strong low. The market takes out this area. Therefore, the market was going back with a fair value gap that we could sell from. But what is the target? You then go back to 15 minutes chart. 15 minutes chart shows you that from here we then broke structure, but we are coming into this area. So from this low to that high, below 50%, you have liquidity plus an order block, and then the market can then push higher. And then that's what we see from the market. As the market then takes this low, from that high, the market breaks structure and it trades into these lows. So this is very important to be aware of your higher time frame structure, right? Your medium time frame structure, you need to be following it, and you need to have that in view. You're not supposed to be stuck on the lower time frame. So the market changed direction from this area, and then we then see the market retracing, dropping below those lows, come back to a key level, then we drop key levels, and then we take out liquidity, we then take out that high, and then we have changed direction up until we get to our key level. These lows are taken out, you know what to do, and up until the market gets into that. So let's just go to our second example. We are looking at a S&P 500. S&P 500. This is a 4-hour chart. The market pushes, take out that high. So with a strong low, we have a weak high, and the market then drops, takes out liquidity, and then we start pulling back. Now, how would we trade that on the 15 minutes chart? As you can see, you then go on the lower time frame. You have your 15 minutes chart pay, and then you look at your structure. The market takes out the high, strong lows, we go high, we come back into fair value gaps, we then break those highs, then pull back, take out liquidity, then break those highs, and then we then break below those lows. Now we are bearish, and the market comes back, doesn't take out those highs, it only sweeps liquidity, right? And then we continue our merry way to the lows. And all the highs, as they are taken out, we are looking for sells. Take out these lows, the market then comes into area of interest, then drop, we then go back. We have these highs over here, the market takes them out, and then because we have not reached our key level, you don't have a market structure shift, right? You don't then count this as a market structure shift. Now you're looking for buys. No, we have not reached our key level. Therefore, if they take out a high that is strong, then you just look at that as a sweep of liquidity. Even if you have a close of a candle above that, then we then look for ourselves to target these lows, and then we retrace, we take out this liquidity that is resting in this area, we start trading to the lows, you see, and the market continues to do that. As you can see, you have this high to this low, the market closes above that. Have we reached our target? No, our higher time frame key level has not been reached. Therefore, we treat that as a sweep of liquidity, not a break in market structure. You then take your entries from there, you're targeting those lows, and the market pulls back, and finally the market gets into this key level. From that key level, now the market has changed direction. According to 15-minute chart, now you're looking for bullish price. So we have the market going high, we have liquidity, we take out all of that, plus there's liquidity, then the market pumps higher, taking out those highs. And at the moment, I have a strong low, I have a weak high, the market is coming down into key levels, and we might be looking for the market to sweep liquidity and move high. But also, we're not supposed to be ignorant of the higher time frame. Now, what is happening on the higher time frame? You see, on the higher time frame of the possibilities, the market is taken out that high. And what am I expecting? A pullback up to where? Below 50%. This area is very important. So the market might come into these areas. You have a change in the state of delivery, you have a fair value gap. That is where you will then look for your 15 minutes to play into those areas. Then you start looking for buys, targeting those weak highs. So that is how we would look at the market. So this is how we then look at the market with all the types of structures. And until we speak again, do learn, back test and apply, then master the craft. And that's how we are going to end this lesson.